All right, good afternoon, ladies and gentlemen. Welcome to our session for this week. Right, as I stated, that I'll be looking at provisions, contingent liabilities, contingent assets, events after the reporting period. I'll just join the staff and explain them as we go. And we should also remember that most probably next week will be our last session. So next week I'll organize a longer session that will involve us doing the concepts, all the concepts that we've done. And I think there's one area that we will not have looked at, which is fair value measurement. So I will find ways that I will make sure that we also cover that fair value measurement. So next week I'll organize a longer session. Please check your groups by Friday. That's when I will give you the timetable for the weekend class. As I said, that it will be a longer session. It will be a longer session of anything from 3, 4, 5 hours, uh, as we try to cover the things that we might expect in our exams. So please, next week, remember we have got a long session. We'll be having a long session either Saturday or Sunday. I will confirm by Friday, definitely. Right, thank you so much. Right, so today I want to look at provisions, uh, contingent assets, contingent liabilities, and the events after the reporting period. If I remember quite well, I gave you the notes, which I expect that you have read, so that we can be able to be faster and I can be able to explain the other concepts involved as we do the questions. But before I do that, I would like to explain some few things. Right. A provision is normally created when we've got a liability of a uncertain timing and the amount of which can only be estimated. For example, you might be having a court case which you know that you are likely to lose. Let's say, for example, someone ate the food from the organization and had a healthy problem, and they are suing the company for that. And our legal team maybe met with the doctors and they found that it's highly likely that the person was got ill because of the contamination from our food. That means by the end of the year, we know that we are likely to lose the case because of the facts on the ground. So because of that, we create what is called a provision. So a provision is created when we are almost certain, when the probability is high that we are going to pay. Although it's not certain, but the probability is very high. If it's certain, we don't have to do a provision. We do a liability. For example, the case has been concluded and the judge has said that we should pay 10,000 and we can't appeal. Then we create a liability, a straight liability, if it's certain. But if it's probable, but not certain, that means it's highly likely, but there's a smaller chance that we can win the case. Or maybe there's a smaller chance that we might not pay the amount. Then in that case, we create a provision. So if it's highly probable that you meet the obligation, you create a provision. Then when it's not probable that you are going to pay, let's say your legal advisors have advised you that there are many things that can indicate that the guy fell ill, might have fell ill from other food that he ate because he didn't just consume our food on that day. And all indications are that we are likely to win the case, but there's also a chance that we might lose it. So if it's not probable that we lose the case, then we create what is called a contingent liability. A contingent liability, we don't adjust our financial statements, we just do a note. Right. Then if it's remote that we lose the case, then we don't do anything. We don't adjust. Right. Then it can also happen that it's us who are expecting to receive money. Now, if it's us who are expecting, if it's probable but not virtually certain that we will receive the money, we create what is called we disclose what is called a contingent asset. If it's probable but not virtually certain. But if it's not probable that we will be successful, then we don't have to do anything. So you have to be very, 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 very careful with the scenarios that we are going to be looking at. I think there's a diagram that maybe let me just open it so that you can, when you have got time, make sure that you revisit it. I sent you the notes already. You already have them. So I just want to just show you so that you can know where the guideline is. Right, it's here. Right. This diagram is the one that determines, let's say, if we are when we are looking at a provision or a liability, right? When it's probable that we will have to pay, then we create a provision. And when we create a provision, we adjust the financial statements. If it's an expense, we record that expense, although we have not yet paid it. Then if it's not probable, then we don't create a provision, but we disclose what is called a contingent liability. A contingent liability is you just disclose the notes in the notes so that the users can know that there's a pending important case, but we don't adjust the financial statements. Then if the chances are remote that we are going to face the obligation, that means it's highly unlikely that we are going to lose. If the probability is almost zero that we'll pay, then there's no provision and there's no contingent liability. You don't have to record anything. Right. So on this side, we're looking at cases whereby we might pay. We might pay. But there are also cases whereby we might receive money, which is dependent on the certain future outcomes. Right. Now, if it is virtually certain that we're going to receive money, then we recognize an asset. We recognize an asset. We record an asset. And if it's income, we record the income. But if it's probable, but not virtually certain, it's not obvious. Let's say it's a court case and our lawyers have advised us that there's an 80% chance that we can win. So that means it's probable, although it's not certain because there's still that 20% chance that we can lose. In that case, we disclose what is called a contingent asset. When we say we disclose, we don't adjust the financial statements. It will only be in the notes to the financial statements. Then when it's not probable that you're going to receive anything, then you don't record an asset and you don't disclose the contingent asset. Right. Any questions? But I'm going to show this properly as we answer our questions. Right. So now I would use the questions because of time. That's why I'm going straight to the questions rather than for us to go through that theory that I gave you. Otherwise, we'll spend the whole class on the theory. Then next week, in our last class, we have to start again on the provisions. So that's why I'm fast tracking. I'm very sorry for that, my very good friends. Otherwise, we could have started by the theory on its own. Right. So we have here. Provisions. Contingents. Assets and contingents liabilities. Right. I will use the questions. I've already sent you these questions that I'm using. I've already sent you already these questions that I'm using here. Right. Our question one. Cosmo Limited is a well-diversified company specializing in the manufacturing of plant products and plant accessories. The annual financial statements of Cosmo Limited for the year ended 28 February 2019 were presented to the board of directors for authorization for issue on 30 April 2019. Right. Then we're told that on 11 January 2019, Remember that our year is ending on 28 February 2019. So 11 January falls within our financial year, right? So we're told that on that 11 January, a Computer Limited replaced all the outdated computers of Cosmo Limited as part of its computer upgrade program, right? At a total cost of 1 million. Unfortunately, the computer supplies to Cosmo Limited were of inferior quality and an insufficient capacity for the normal day-to-day operations of the company. After numerous attempts to resolve the matter, Cosmo Limited sued Computer Limited on 10 February 2019 for 300,000. At year end on 28 February 2019, the company's legal advisors are of the opinion that it is probable, but not virtually certain, that Cosmo Limited will be successful with their claim. All right. My friends, if it's the company that is suing another party and that will likely receive money because of the scenario that we're talking about, then you should know that it's either an asset or a contingent asset, or you don't do anything. If it's the company that is suing another party, that means we expect to receive money. So we're talking about, we're on the asset side, not on the liability, right? There are three scenarios. If it's virtually certain, we recognize an asset and adjust our financial statements, right? So we are saying, what I'm writing, guys, it's not part of the answer if you're in an exam, but this is just to explain to you, right? If the company is expecting to receive money as a result of a situation, and the receipt is only dependent on uncertain future outcomes, there are three possible scenarios. Number one, if it's virtually certain that the entity will receive an amount from the scenario, recognizing assets. So that means when we're recognizing an asset, that means adjust the financial statements. Then number two scenario, if it's probable but not virtually certain, recognize, disclose, not recognize, a contingent asset. So the contingent asset will only be in the notes to the financial statements. Then the third scenario, if it is not probable, then no recognition and no disclosure will be made. So you have to check and assess your situation and see under which scenario does it fall. Right. Now here, our lawyers have said that it is probable but not virtually certain that will be successful, that is, will receive the money. So this one will be a contingent asset. It's a contingent asset. It will only become an asset if the outcome is favorable to us. So now the question here, all the questions here are about disclosing the information. So when we disclose the information, although we don't know yet what will happen, but there's a probability that we can win the case. So we do a note for the contingent asset. So say extracts of the notes, the financial statements of Cosmo Limited the year ended 28 February 2019. Right. We call it contingent asset. It will be called contingent assets. Right. When you are doing the contingent asset note, all these things that I'm writing, they are also in your document. Right. You should disclose the nature of the issue at hand. So you have to say that they were, I think they said that there was something that was supplied and it was of inferior quality. We have to describe that. Number two, the amount likely to be received. So we have to state it has to come out. How much are we expecting to receive from that condition? Then number three, the justification for classifying it as a contingent asset. So when we're talking about this, for example, it can be legal advice. By our lawyers. Or maybe it can just be someone who is senior within your company who gave you the likely outcome because of his experience. You trust in his judgment. So you are using that. So that is what we are supposed to do. So that means in this scenario, you just summarize. It's one of the easiest notes. You just summarize what is here. We just have to state that during the year, Computer Limited sued, Cosmo Limited sued Computer Limited for 1 million. What was that 1 million for? For computers which were supplied, inferior computers of inferior quality and insufficient capacity which were supplied. Then what made us think that it's a contingent liability? Then we can say that the legal advisors are of the opinion that it is probable, but not virtually certain that the company will be successful. So a contingent asset, you just summarize what is there. So it's not a difficult note. So you can say during the year, Cosmo Limited instituted a claim against Computer Limited for inferior quality computer supplies. Right. They instituted a claim, let's say, of 300. That's is it 1 million? 300,000. Right. According to the legal advisors of the company, it is probable, but not virtually certain that the company will be successful. Their claim. Right. So you will have brought into light everything that is happening here. So we now know that this company made a claim, and that claim will be decided in future, and it is probable that the company will be successful, and this were told by our lawyers. So that's the contingent asset note. Any questions there? All right, so let's go to the second question. So that's even the contingent liability is just as simple as that, nothing much, right? But so you should be able to judge whether it's a contingent asset, contingent liability, provision, or what. Right. Question 2. Megawatt Limited is a manufacturer and retailer of electrical appliances. The financial statements of Megawatt Limited for the year ended 31 December 2018 were presented to the Board of Directors for authorization for issue on 10 March 2019. The profit before tax of Megawatt Limited amounted to 1,650,000 before taking into account the additional information below. Then the additional information. Now required, disclose the above information in the notes to the annual financial statements of Megawatt Limited for the year ended 31 December 2018. All right. So we have our notes to the financial statements of Megawatt Limited for the year ended 31 December 2018. Right. So let's first identify what is it that they are talking about. Right. On 1 March 2019, which was, so I think there's something wrong with this. How can the year end be 2018 and this one? These things are 1 March 2018. Let me just verify if I'm okay. Let's move on. On 1 March 2019, an invoice amounting to 120,000 was received from Mechanical Limited in respect of maintenance work performed on the manufacturing machine during the year ended 31 December 2018. This invoice was received after year end, because our year end is 31 December 2018. Right, the invoice indicated that 70% of the maintenance work on machinery was completed before 31 December 2018. And 30% of all the maintenance work on machinery was completed in January 2019. Payment to Mechanical Limited will only be made once the maintenance work on machinery has been fully completed. No provision for maintenance costs on machinery for the 2018 financial year has been made yet. The provision for maintenance costs on machinery on 31 December 2017 amounted to 45,000. In February 2018, Megawatt Limited paid 30,000 as the only and final payment in respect of the maintenance work of machinery performed in 2017. Right. So that is the scenario that we have. This is the first part. The next case is a different one. Right. There's a provision here that is to be created. Because it is probable that they will pay the money when they receive the statement, because they know that the maintenance work has been done. So in such a case, we create a provision. Because the maintenance work, they know that every year the maintenance work is done and will definitely pay. The only problem is we don't know the exact amount. It will only be confirmed at a later date. So they have to create a provision. And number two, there's something that I also have to bring into account, which I want to discuss today, which is called events after the reporting period. Right. Our reporting period is ending 31 December. But the financial statements will be authorized for issue on 10 March. So any event that happens between 31 December and 10 March is called an event after the reporting period. Right, these events, they can be classified into two. We have what we call a adjusting events and what we call non-adjusting events. Adjusting events are those circumstances that we learn after year end, but they represent circumstances that existed at the reporting date. That means those things, although we are getting new information after year end, but they were already there at year end. Like in this case, this maintenance work, this 70% of the work was already completed by 31 December, but we had not yet received the invoice. The invoice just came on 1 March to confirm that. So this is an event that existed at the reporting date. So we have to, we call it an adjusting event. So we have to adjust the financial statements for 70% of the work that had been done by year end. Right. Then a non-adjusting event is an event that happens after year end, which was not even there at year end. Let's say, for example, our year was ending on 31 March. Then today, there's a fire in our factory which destroys inventory. By 31 March, there was no fire, and we were not expecting a fire. So that would be a non-adjusting event, which we just disclose in the notes to the financial statements. Right. So this one will fall under the category of adjusting event, considering that by 31 December, 70% of the work had already been done. So that means we're already owing for the 70% of the work. So we create a provision. Now, from last year, there was a provision of 45,000. When we're creating a provision, we mean this is what we are likely to pay because of this maintenance. We have not yet paid, but the supplier is not yet confirmed, but we're estimating that we're going to pay 45,000. But at the end of the day, you might not pay 45,000. As you can see that they paid 30,000. Right, so we have to do a note. Right. Provisions. Provision for maintenance costs. Right, we have 2017, 2018, and 2017. Right. Right, the following have to be shown in your provision notes. The carrying amount at the beginning of year. That means our carrying amount at the beginning of the year. Carrying amount at the beginning of the year is the provision that is coming from the previous year. So in 2018, we carrying amount at the beginning of the year will be the provision that was created in 2017. Right, in 2017, they created a provision of 45,000. Then in 2016, there was nil. So that means we'll have 45,000 in 2018 and 0 in 2017. As I said, the carrying amount at the beginning of the year is the provision which is being brought forward from the previous year. So considering that in 2016 it was 0, that means the opening balance for 2017 will be 0. But in 2017 we had 45,000. Right. Then we have to deduct any amount used during year. Right. Let me just describe these things. Carrying amount at the beginning of year This is the provision created at the end of the previous year. Which is brought forward. Current year. Right. Then amounts used during the year. These are the amounts paid in current year relating to provisions of last year. Remember, when we are creating a provision, we are saying this is the amount that this is the expense that we've already incurred it, but we're not yet sure of the amount. So because of the matching concept, we have to show the amount in the financial statements. These repairs have already happened this year, but we're not yet sure what will be the amount. We'll only verify when the invoice comes. So in the meantime, we create a provision. Why? Because the work is for this year. That's why we have to create a provision at the end of the year, although we are not yet certain of the amount. Right. But then when we come to next year, we'll verify the actual amount. So it has to come from the provision. Right. So if you can check here, the final invoice in February, they paid 30,000 is the final payment for 2017. So out of this 45,000, they then paid what? 30,000. Right. Then any unused provision. So we're saying provisions made in previous year which are not paid. Or excess of provision made over the actual payment should be reversed. So although we provided for 45, we only paid that. So the excess has to be reversed. So that will be the 15,000. Here we have a 0. 15,000 is coming from 45 minus 30. Maybe let me just write here. It has to be reversed. We have to reverse that unused provision. Right. If we pay more than 45,000, let's say they paid, the actual payment was, let's say 50,000. Here on the amounts used, we only record the 45,000. The other excess will go directly to expenses. In the provision, we can only write off up to the provision which was created. Any additional amount that is paid will go directly to expenses. Right. So when you reverse, you only reverse if the provision that was created was more than the actual payment made. Then we now have the provision created for current year. Right. For 2018, we only have to create a provision for the work that has been done. But they're saying 70% an invoice for 120 was received from in respect of maintenance work performed on the manufacturing machinery during the year ended 31. The invoice indicated 70% of the work on the machinery was completed before 31 December, and 30% was completed in January 2019. So the provision will only be for work that was performed during the period. So would say 120,000 times 70%. What do you get? Thank you. 84,000. Then here, remember, they created a provision of 45,000 in 2017, which became our opening balance here. Right. Then we get our carrying amount at end of year. Right. Then you should also give a brief description that provision is made for maintenance costs relating to what were they maintaining again? Machinery. Maintenance work performed on machinery. Right. So this is how we do a provision note. So if there was a balance from 2016, it was going to be the carrying amount at the beginning of 2017. Any questions? All right, we'll go to the next one. Right. Due to the rapid expansion of Megawatt Limited, the computers leased by Megawatt Limited from Modern Limited became inadequate and outdated. Subsequently, Megawatt Limited decided to terminate the operating lease agreement with Modern Limited. The current operating lease agreement with Modern Limited for the lease of computers expires on 31 December 2020. The computers leased from Modern Limited were determined to be low value assets. The operating lease agreement stipulates that early termination of the lease agreement will result in a penalty of 380,000. The rent, according to the operating lease agreement, amounts to 15,000 per month, payable in arrears. All the lease payments for the year ended 31 December 2018 have been paid up to date. Right, here we create what is called a provision for onerous contract. Provision for onerous contract. So if there's a contract that is likely to be breached and it might result in a penalty, we create what is called a provision for onerous contract. Right, it's just like that other provision. So we can have 2018. Right, so we'll have exactly the same things here. Right, our carrying amount at the beginning of the year is 0 because there was nothing. Then amount used from last year it's 0. Right, a reversal it's 0. So if you're in the exam, these two you would leave them out. But we create a provision. Right, how much will you create? Provision for onerous contract. Right, the amount to measure the provision will be the lower of the penalty and rent payment. Right. So I want you to see something here. The penalty is 308. The rent is 15,000 per month. And our breach is for a period of 2 years. Where is my 2 years coming from? This is 31 December 2018 when we were breaching the contract, but the contract was supposed to end in 2020. So we still had 2 years to pay the rent. So the penalty is 380,000. Rent house is 15,000 multiplied by 24 to take into account the 2 years. Remember, the 15,000 is per month. What do we get? Thank you. 360,000. So that will be 360,000. So use the lower, which is 360,000 as your provision. Why? Because if the penalty is 380, instead of paying the penalty, we can just stay in the room, although we're not using it, and just pay the rent 15,000 every month for 2 years, even if it's empty. That's better for us. Even the landlord, you can even tell him that, okay, I'll pay the rent, but I'm going out. They would even take that option. Rather than to pay a penalty of 380, would rather pay the rent. So that's why we take the lower. If the penalty is lower, then we can take the penalty instead of paying the rent. So when there's an onerous contract, a likely breach, we have to measure what is the cost of fulfilling the contract versus what is the cost of the penalty. Whatever is the lower option, or every reasonable person will take the lower option. All right. So that will be the provision for onerous contract. All right. Then we have to make a description of the circumstances that are here. All right. All right. So we can just summarize. Due to rapid expansion, the computers leased from Model Limited all right. To be replaced as they became inadequate. The lease contract was due to expire on 31 December 2020. Right. With rental costs of 15,000 per month. And an early termination penalty. Of 380,000. Right. So you just give a brief description there. Any questions? So please, you have to see what is the better option. Sometimes they can tell you that it can be sublet at an amount of so much. So the provision will be the net off of the rent that will pay the landlord and the subletting that can happen. Right. Then on 31 December 2018, the union representing the permanent employees of Megawatt Limited and the management of Megawatt Limited were busy with negotiations for discretionary performance bonuses estimated to amount to 900,000. All permanent employees are entitled to a discretionary performance bonus according to their service contracts. However, the managing director of Megawatt is of the opinion that the company will probably not settle for the payment of the discretionary performance bonus to the permanent employees due to poor profitability results of the company. Right. Our expert has told us that it is not probable that we are going to pay the bonus. Since it is not probable that we are going to pay it, we have to disclose it as a contingent liability. Right. During the year, the company began discussions with the union representing the employees for a discretionary bonus of 900,000. And all permanent employees are they say they are what here? Are entitled to the discretionary bonus. At year end, the managing director of the company is of the opinion that the company will probably not settle for the payment of the discretionary bonus due to poor profitability results. Right. So that is the note that will be recorded. Right. Any questions there? Right. Right. Now with question 3, I will just explain to you without writing. Then you just see. When you are alone, you can just try to maybe do it to check if you can be able to do it. Right. Ubuhle Limited is a diversified South African listed company involved in the manufacturing and retail of medical products. These medical products are sold locally and overseas. The profit before tax of Ubuhle Limited for the year ended 31 December 2018 amounted to 1,950,000 before taking into account any adjustments as a result of additional information below. Right. Now the question is, give the disclosure requirements of the claim of 150,000 in additional information 1 in the annual financial statements of Ubuhle Limited. Right. Now, Ubuhle Limited started to export the weight control tablets to the United Kingdom. Ubuhle Limited widely advertised this product in the UK press. The advertisements of the weight control tablets included the slogan, "Lose the belly with our weight control tablets and keep drinking beer." As a result of this advertisement, the United Kingdom Brewers Forum, UKBF, instituted a claim of 150,000 against Ubuhle Limited on 15 December 2018. They are of the opinion that this advertisement insinuates that men in the UK are overweight due to drinking beer, which negatively affected beer sales. At year end, on 31 December 2018, the lawyers of Ubuhle Limited estimated that there is an 80% probability that the claim will be unsuccessful. The court case is scheduled for 24 February 2019. Right. So we are going to, when you discuss this, you'd say that there's a claim against the entity. So this claim can either be a provision or a contingent liability, or we do nothing. It is a provision if it is probable that the entity is going to pay the claim. And it is a contingent liability if it is not probable that the company will pay the claim. And if it's remote, then we do nothing. Right. Now, there's an 80% probability that the claim will be unsuccessful. Read this properly. That means it is not probable that the company will pay, because the probability of paying is just 20%, which is less than half. So it is not probable that the company is going to pay. As such, you disclose a contingent liability. Contingent liability. And the contingent liability you disclose in the notes to the financial statements. You don't adjust the financial statements. And in the notes, you would state the amount, the nature of the claim, and the basis that led you to conclude that it's a contingent liability, which is the estimated probability that the claim will be successful. So those are the things that we disclose. Any questions there? All right. Number 2. Okay, let's go and check. So this one will be contingent liability. Then in B, discuss with reasons if the provision for future operating losses, additional information 2, in the accounts of for the end, the one complies with the definition and recognition criteria for a provision. Right. Right. Ubuhle was an exhibitor at the annual London International Medical Exhibition held in May 2018. The directors decided to exhibit the new range of medical products at the next exhibition to be held in May 2019. The rent of a bigger stand at the medical exhibition in May 2019 is significantly higher than in May 2018. The directors are of the opinion that Ubuhle Limited will incur operating loss in respect of 2019 exhibition, as the operating costs, including the higher rent, will be much higher than the anticipated sales. A provision of 250,000 for a future operating loss in respect of the 2019 exhibition was made in the financial statements of Ubuhle Limited for the year ended 31 December 2018. Right. Now, when you discuss this, you would say that the financial statements are for the year ended 31 December 2018. So anything that will happen in future cannot be regarded as having happened at year end. So remember that we use the matching concept, matching principle of accounting. So this event has not yet happened, and it will only happen in future. So there is no liability at the moment. We only recognize, we will only make a provision if there is a liability, and the liability can be constructive or legal, right? So there's neither a legal obligation or a constructive obligation from this information. So there's no obligation that they're going to pay. So it's a loss that might happen in future, which has not yet been incurred. So it cannot, it doesn't meet the definition of a provision. So we don't have to record it. So future operating losses will not be recognized as a provision in terms of IAS 37. Because the liability is not yet existing at year end. Right. Then disclose additional information 3 and 4 in the notes. Right. Number 3, on 17 December, Ubuhle Limited instituted a claim of 855,000 against Snoop Limited. So is the company instituting a claim, a major competitor of Ubuhle Limited. The research staff of Ubuhle Limited discovered that Snoop Limited illegally copied Ubuhle Limited's antiretroviral medication formula. At year end on 31 December, the lawyers of Ubuhle Limited are of the opinion that the claim will probably succeed, but they are not virtually certain. Right? If we are suing and it's probable but not virtually certain, that would be a contingent asset. So you record it the same way that we did the contingent asset on number 1. So you just follow number 1. Why? Because it's probable but not virtually certain that will be successful. Right. Then number 4, since March, Ubuhle sells nebulizers with 1-year warranty. The warranty is an assurance type of warranty. According to the terms of the warranty, Ubuhle Limited will repair or replace manufacturing defects that become apparent within 1 year from the date of sale of the nebulizers at no cost. Based on estimates, the warranty provision created for the nebulizers for the year ended 31 December 2017 amounted to 240 in respect of nebulizers sold during 2017. Actual repair costs in 2018 relating to the warranty given on nebulizers sold in 2017 amounted to 250. Actual repair costs incurred in 2018 relating to the warranty given on nebulizers sold in 2018 amounted to 175,000. The warranty provision created for the nebulizers at year end on 31 December amounted to 300,000. Right, so it is this one is a provision. So you just do it the same way as what I did the provision. You know that the opening balance will be 240 in 2018, which is the provision created in 2017. Right. Then they then paid 250. Remember what I said, if you pay more, you just take out from the provision only 240. The other 10 will go directly to expenses. So there will be no reversal in this particular case. Then you then create a provision for 300,000. This repairs for the current year will not go in the provision. Repairs for the current year will be recognized directly as an expense. They are not recorded in the provision. Only the repairs relating to the provision created last year, which is the 250, is the one that will go to the provision, but only up to the 240 that was created. So please try to do these questions, and then you can, if you have done any part, you can inbox me, then I can show you how to do it. You can try the other questions, it's just the same things of the provisions, the contingent assets and contingent liabilities. All these questions, it's one and the same thing. So please go through them, and if there is any part that you don't understand, then you can be able to ask. Any questions? Right. So if we don't have any questions, then we'll meet during the weekend. As I said, during the weekend, I will verify the times by Friday. But during the weekend, we will do a session either Saturday or Sunday, and it will be a longer session. So we'll meet during the weekend. Thank you so much, and God bless you, Richard.